Welcome back. Let's check markets. And the yield on the 10-year is up again this morning. It is up 1.5 basis points, with the yield on the 10-year sitting just below 4.3%, 4.28%. Markets reacting to President Trump's nomination of Kevin Warsh for the chairman of the Federal Reserve job. Outgoing Senator Tom Tillis, however, says he's not going to back Warsh until the investigation into Jay Powell and the Federal Reserve's renovation is over. The Fed, of course, paused rates at its first meeting of the year after 3 consecutive rate cuts. Traders are still pricing in at least 2 cuts for 2026. I spoke with Kevin Warsh back in October about what he called a series of mistakes by the Fed. Watch. Kevin, what's your take on what is required, what is needed to give this economy a boost? And given the fact that inflation is still pretty tame, should they be doing a string of cuts into 2026?
Yeah, well, I think they've made a series of mistakes, not just in the last year, but the last 5 or 6 years. And I think their track record is really quite poor in forecasting the growth of the economy from policies like the ones the president put in place. And their inflation forecasts have been terrible, too. That's why they were so late, and that's why we had this surge of inflation that's done the most harm to the hardest working Americans among us. So that track record, I think, still matters, Maria. The reason why most households, most businesses think that inflation is going to still be well above 2% is because that's what the Fed's delivered. I think until there's regime change at the Fed, until there's new people running the Fed, a new operating framework, they're stuck with their old mistakes.
Well, that day is coming soon. Joining me now is Federal Reserve Governor Stephen Myer. Stephen, great to see you. Welcome. Thanks so much for being here.
Good morning. Thanks for having me back. How are you?
What is your reaction to the nomination of Kevin Warsh?
Oh, I think Kevin Warsh is a fantastic choice for Fed chairman. I mean, I think this is just great. This is a guy who's extremely well respected across the financial industry, on Wall Street and investment committees. He's extremely well respected among economists, and he's extremely well respected among policymakers. I think he's just a great choice, and I'm very excited to see the things that he's going to do at the Federal Reserve.
So knowing the backdrop as well as you do as far as the macro story, what is required in your opinion? I mean, I know that the market's expecting at least 2 rate cuts from the Fed this year, perhaps 3 rate cuts. Then there's the balance sheet issue. So assess what you believe should be the right course of action today.
Yeah, so I think we need to cut rates a bit more than that. I'm probably looking for a little bit more than a point of interest rate cuts over the course of the year. I mean, look, I think that the inflation data have been a little bit distorted by some anomalous features. For example, the way that we calculate portfolio management services and inflation, it basically just ties to the stock market. So the stock market moves higher, it mechanically brings the way that you calculate inflation up and gives you what is, in my mind, a misread of where inflation is really running. And so when I look at underlying inflation, I don't really see a lot of very strong price pressures in the economy. I don't see a lot of strong supply-demand imbalances of the type that monetary policy should respond to. So I think we're keeping rates too high, mostly because of quirks of how we measure inflation rather than actual price pressures themselves.
I mean, Stephen, you've studied this market for so many years, decades, and I'm just wondering what your reaction is to the fact that the market is fully expecting lower rates. We are fully expecting a different tone this year, and yet rates keep going up, right? I mean, this morning, right now, the 10-year is up, now sitting just below 4.3%. Why?
So there's a lot of things that go in. There's a lot of things that go into financial markets. So since when we started cutting rates, I guess 10-year yields were about 20 basis points lower than they are now. So it's not really that much of a move higher since we started cutting interest rates. Certainly that's in contrast, I think, to what happened to interest rates after the cuts in 2024 when they moved well over 100 basis points in a roughly similar amount of time versus when the cuts began. But I think there's a number of things that go into that. I think part of it is better growth expectations for the year. I have some somewhat better growth expectations for the year based on the implementation of the One Big Beautiful Bill, based on the ongoing course of deregulation. I gave a speech on the effects of deregulation on the economy in January. It's going to be a powerful productivity enhancer. It's going to boost productivity throughout the economy, and it's also going to bring prices down because when you create the ability to make more stuff, you ease supply-demand balances, and that's very disinflationary. So there are some reasons to be optimistic about economic growth. However, it's not necessarily the type of better growth that requires tighter monetary policy. Part of the reason is because those types of better growth create what we call an output gap. They boost the supply side of the economy more than they boost the demand side of the economy. That creates space for monetary policy to accommodate that growth. There's also been a little bit of a disconnect between the labor market and the top line GDP data, and both of those, and that also provides some additional space for monetary policy to accommodate that better growth.
Yeah, in fact, in regards to deregulation, I mean, this was one of President Trump's main priorities, right? Get out the red tape, take it out, deregulate. And now Barron's has this new op-ed saying this: Stephen Myer is right about the big Fed blind spot. They write, Myer argued that regulation and deregulation can materially affect productivity, output, and inflation. Myron's argument rests on a simple but often neglected insight, which is that regulation is a supply-side policy. Stephen, how much more regulation is there to take out? How long is this runway?
Well, look, I mean, obviously I agree with that Barron's piece. I mean, a lot of people just spent many years blaming inflation on supply chain constraints, right? What cutting regulations does is eases supply chain restraints. It seems very odd to me that if you thought that supply chain constraints caused inflation on the way up, that you wouldn't think that easing of supply constraints would cause disinflation on the way down. It should be symmetric. And when you remove regulations from the economy, you increase the ability of firms to respond to demand changes, and that reduces inflation. It increases productivity. It eases barriers of entry, allows for more competition. I went through all of these things in my speech. I quantified them. I quantified using the economics literature that if the pace of deregulation that occurred in the first half of last year continues, it's going to end up dragging on inflation by about 0.5% a year. Yeah. So that's a very powerful productivity-driven, supply constraint easing-driven disinflationary force that's in the pipeline.
Yeah, I mean, look, I love the productivity story. Obviously, productivity is soaring, and that is also due to the president's efforts to get the supply chains back in America. But when you look at sheer inflation, I mean, I recognize the president and your efforts have been able to rein in inflation, but the December producer price index was hotter than expected. We had a monthly gain of 0.5%. We saw that live on this program. We have a gain of 3% year over year, Stephen. So what's the answer here? What else is needed to rein in producer inflation?
Yeah, so there's no question about it. The producer inflation measure was hot by any way you slice it. However, it's important to note that the Federal Reserve doesn't target those prices. Those prices don't measure what anybody in the economy really pays from a consumption point of view. We target consumer prices as we've measured them through the Personal Consumption Expenditures Index. Now, some of the components of PPI, of the Producer Price Index, flow into the PCE, the Personal Consumption Expenditure Index, because of how it's calculated. Among them are those portfolio management fees, like I described before. But a lot of those, but what those fees end up doing is end up distorting our final rate of consumption and biasing the number, what in my view is too high and above what reflects the true supply-demand imbalances in the economy. So the PPI data are interesting. I think that they're important to look at because no single piece of data gives you an entire view of the whole economy. But we don't target PPI, and elements of it flow through into the things that we do target.
What do you make of this move in hard assets? I mean, you're talking about a double-digit move year to date, and it's only been a month. 12% higher for the price of gold. Double-digit gains for the price of silver, copper. What's behind that, and what's the impact?
So, I don't know exactly what's behind it, but I can tell you that I think it makes sense to look at these things in context. And when you look at what happened in the last 6 months of last year, right, the moves on the upside on some of these things were just phenomenal. And there was clearly a lot of leverage involved. And I think the type of behavior you see now happens in highly levered markets that are not the most liquid markets in the world, that are not the biggest and deepest markets in the world. And this is just the type of behavior that you see in commodity markets and cycles, over and over again. It's not something that I really read a lot into economically. It's not something that enters into too many economic variables of the type that the Federal Reserve really focuses on. Right. But it's markets always have this boom bust cycle behavior, particularly with leverage involved. I think it's something. It's eye popping, but it's of limited information content for what the Fed does.
That's fine. But what about employment? That's obviously one of your mandates, full employment. And you have a major pivot and turning point in the economy right now with artificial intelligence. I mean, AI efficiencies are clearly cutting jobs. What's the plan to replace those at the Fed?
Yeah, so that's a great point. I mean, I do think that there definitely is an aspect of that when you look at the economic data. Now, historically, there's always been new technology, there's always been innovation, and it's always destroyed jobs. But what the economy does is it creates new jobs to replace those old jobs. And sometimes those new jobs are in categories that nobody could have imagined. And so one example that I like to point to is that, social media affected a lot of jobs in the journalism industry. But it also created new job categories like social media advertising strategists that nobody could have dreamed possible in the years before. I mean, I wouldn't have thought that's possible. And so I'm sure that AI is going to create new job opportunities as well of the types that we just can't imagine yet because we don't actually see them being implemented. It'll take some time to figure out what those are. Now, it's also my view that the Federal Reserve has a role to play in accommodating this transition. Right? I don't view AI as some force that's permanently destroying jobs in the economy. No previous technology has done that. We've always created new jobs as the economy rotates from one sector to another, from one type of profession to another. And I have no doubt that the same thing will happen again because we've got thousands of years of human history, hundreds of years of capitalistic history, and this always happens. But it is the Fed's job, in my view, to accommodate that transition as new jobs can be created.
Stephen, real quick before you go on the balance sheet, what do you want to see happen here? I mean, obviously the balance sheet had gotten blown up, so high during the dot-com boom and bust and the financial collapse, and Jake Powell has been watching it come down. Do you need it to go lower? Where do you stand on the balance sheet cuts?
So, look, at the present, we're expanding our balance sheet through these reserve management purchases just because we have to accommodate increasing demand for reserves in the economy. In the longer run, I would very much like to reduce the balance sheet further. I think it's a good idea for the Fed to have a smaller footprint in the economy if it can. And so I think further balance sheet reduction would be a good thing. However, you can't reduce the balance sheet until we get more regulatory reform under our belt. So I'm very excited that I think that a new drive to reduce the balance sheet under Chairman-designate Warsh, if he goes in this direction, will end up turbocharging Vice Chairwoman Bowman's deregulatory agenda for the banks. Because if you're going to reduce the balance sheet, you need to take aggressive steps to reduce the regulatory-driven demand for reserves and increase the capacity of the banking system to absorb increased supply of securities. So I am optimistic about our ability to reduce the balance sheet in the long run. However, there's a lot of steps you got to take before you get there.
And do you have common ground there on the Fed? Because we've got lots of back and forth in terms of your own colleagues. I mean, just today, Raphael Bostic is saying no Fed rate cuts in 2026.
Yeah, look, there's obviously a very strong diversity of views. Everyone's responsible for their own view. I've given mine. I think that we're too tight. I think we're being fooled by quirks of how we calculate inflation rather than actual price pressures in the economy. I think that's leading us to target to leave our Fed funds target rate too high. I think it's also masking how tight we think the economy is, because when people look at real interest rates, they usually take the headline interest rate and they subtract inflation to look at the real interest rate, but they're subtracting an inflation rate that's just too high because it's distorted. And so I think people are confused about just how restrictive monetary policy is. So everyone's got their own view. At the end of the day, we're a committee and we take votes. I'm just one member of that committee. But I'll continue arguing for my view because I think it's right.
Does Raphael Bostic have support on the Fed for no cuts?
Well, you've got to look at the most recent statement, summary of economic projections, and the guidance from Chairman Powell about where the rest of the committee is. They've all got their views and they're entitled to their views, and I hope that we cut interest rates further. But I can only speak for myself and my own view.
Stephen, it's great to see you. We so appreciate your time this morning. Thank you, sir.
Thank you.
All right, Steven Myer joining us. We'll be right back. Stay with us.